Now let's take a look at those interbank rates, really falling back to 10.3% from 12.7%. The high interbank rates have provided some support to the shilling over the past few weeks. What impact will this drop in rates have on the shilling going forward?
Well, it's very interesting. It remains to be seen how this goes on forward, because previously the low interest rates provided an arbitrage, the arbitrage position, so that people holding Kenyan shillings were dumping them for other hard currency holdings. But right now, one of the things that has changed since that time is that inflation has come down. So in terms of real interest rates, perhaps we still have a good margin there. So perhaps that will be able to keep investors local and foreign investors wanting to keep investing here, as long as the real interest rates remain positive. But if inflation begins to tick up, then that would be our cause for concern. But as long as inflation trends downwards, the shilling shouldn't have a problem.
Looking at the shilling at these levels, what levels are you seeing the shilling trading at this week?
Well, the government said it, they wanted at 82. I suspect we would be seeing too much deviation from 82. So that perhaps should be where we'll be looking at. Obviously, shocks could push it most likely downwards, but 82 should be where everything will settle at.
Now coming back to the equity market, well, it's a start to a relatively short week. Market has been above that psychological level of 3,400 points, but falling back in today's trading session. Are you perhaps seeing a further upside to the market going forward, and what is likely to drive this momentum?
Well, again, today we saw a slight dip, went below the 3,400 level. But as long as, again, interest rates keep trending downwards, then you're going to see a lot more money leaving fixed income coming into the coming to the equity side. One cause for concern, though, again, like I said earlier, is foreign investors that have been propping up the market quite a bit. Any profit taking, of course, will probably lead to a lower index, but and lower market levels. But I think the trend in interest rates will serve to support the market, simply because perhaps where foreign investors will feel like leaving, the locals can then take up the slack.
Now looking at some of the stocks, we had Safaricom, a stock that really has attracted a significant attention on speculation that the company will maintain its dividend at the same level as last year. Company moved close on 61 million shares in today's trading session. Are you also buying into the story of Safaricom?
Well, perhaps there's a case there, because just towards the end of the first half of the fiscal year, they were forced to raise their tariffs, especially their voice tariffs, and that went up by about 33%. So and that didn't really hurt their calling rates too much. I think the elasticities there work in their favor. So basically, what we're expecting is increased revenues from voice. We also expect increased revenues from data and M-Pesa. So perhaps those three business lines, the income streams there should help, perhaps maintain the dividend. But again, like you mentioned, the risk of a drop in dividend payout is high. And at some point, we were even worried that we might have to see 15 cents or maybe 10 cents per share. But perhaps there's room for optimism given the recent dynamics.
There's lots of optimism around Safaricom, but you see the share still trading at around 315. Really, it hasn't moved beyond 315 at all. Do you perhaps see the stock moving perhaps to 340 on this positive outlook?
At least in the short term, the outlook might be iffy, but in the medium term to long term, you expect a rebound in revenues and of course performance. And this may not necessarily be driven by voice, which was what suffered last year, but also by data and M-Pesa, which now is becoming a significant income stream going forward.